January 3rd, 2026. In a massive overnight raid, the United States forces captured Venezuelan President Nicolas Maduro. Then, on April 24th, 2026, a U.S. Army operative involved in the planning and execution of the operation was charged with using classified information to place bets on whether Maduro would be removed from power, earning him $400,000 of revenue in the process. Later that day, Trump is questioned by reporters about this case, and the response he gives sounds like something you would have heard from a critic mortally outraged with the capitalist system as it stands.
The whole world, unfortunately, has become somewhat of a casino. It is what it is.
It is what it is. A critique emptied of opposition. A resignation spoken from the most powerful person in the world. The world has become a casino, and power does not deny or even really defend it. It just nakedly affirms it. That is the world now, and there's nothing left to be said. When I first heard this, I was immediately reminded of Jean Baudrillard, the provocative theorist of the simulation par excellence, often called a postmodernist by both his allies and his enemies. In his book The Agony of Power, he discusses how power no longer really has to veil itself under the positive values of freedom, democracy, equal rights, or progress. Instead, power now frequently appears denuded. It uses language cynically to ironically mock any criticism in advance. As Baudrillard writes, it can admit its crime in broad daylight, and appear more honest and truthful than ever before because of it, as we know when people call Trump the most honest politician in Washington. Power has learned to say the quiet part out loud, because saying it out loud no longer changes anything. It circulates the quiet part as content. It becomes another tradable sign of the system's own decay. If anything, it can inflate what Baudrillard would term sign value. But this is only the surface level of the story. What struck me more, the further I kept going down this rabbit hole, was that this was also about finance and simulation. It gives us a window to see how monetary signs no longer merely represent the world, but begin to anticipate it, price it, and perhaps even shape it before it happens. After all, years before Trump described the world as a casino, it was Baudrillard who claimed that the world dominated by finance co-opts the energy of poker. This story also gives us insight into an entire speculative atmosphere that has surrounded Trump's second term from the beginning. We can think of all the well-timed whale trades before tariff reversals, the evidence of market manipulation after Trump posted that it was a great time to buy hours before a tariff pause sent stocks soaring, suspicious wagers around military action in Iran, and the list goes on. None of this proves a grand conspiracy. In fact, it barely makes the news to begin with, and even if it does, it becomes instantly normalized. Financial speculation directing political operations is far from being new in America. What may be new, however, is the degree to which this logic no longer requires a conspiracy, or even an identifiable human conspirator at all. To treat all of this merely as corruption or insider trading would still make this seem like an exception to the rule. A collection of bad actors exploiting an otherwise rational market. What Baudrillard foresaw, however, is that the market's detachment from reality has become so systemic that any notion of a rational market becomes a mere myth, created only to sustain the world casino that simply is the economy now. A recent Substack article titled "The Wile E. Coyote Stock Market Explained" gives us some insight into this Baudrillardian conclusion. The Trump stock market seems to defy comprehension. Consumer sentiment is at an all-time low. The S&P 500 is at an all-time high. The market gets pushed up by Trump's statements about the war that no rational human being would believe. A lot of trading isn't being done by humans but by algorithms that search the news and what's trending on the web for clues about how the market will move the next day. So when Trump truths that the war with Iran is over, they're opening the strait and have agreed to all his terms and are becoming the 51st state, the algorithm doesn't need to believe him. It just needs to see that, true or not, this statement will move stocks up and oil down. With so much trading done by algorithms, each algorithm knows stocks will rise because the other algorithms will move them. Each algorithm anticipates the response of the others, producing a market that increasingly moves in response to its own predicted movements. The question is no longer whether a statement accurately represents economic reality then, but whether it can trigger the correct chain of signals within the system. Moreover, virtual and speculative trading have already seeped into every aspect of our economy, so this chain often never even has to pretend to refer back to any material reality. Crypto, NFTs, metaverse real estate, and inflated tech valuations normalized a world where simulated economic value predominated across all markets. But despite such normalization, it still seems to me people remain stuck in a past understanding of the economy, and even if they realize the absurdity of it, how detached it is from what was once considered real, they are not usually able to explain just how much blowback it has generated in all of our lives, whether we own stocks or not, nor how we got to this point. For years, the stock market has become increasingly detached from material economic production, even as it has come to exert greater power over the so-called real economy. When we consider how simulatory the stock market is, how disconnected the ticker so often is to a company's material production and profitability, it is tempting to think finance is simply broken off from the traditional economy full stop. But what is happening in contemporary hypercapitalism is much more catastrophic, and has huge impacts at every level of the economy, and thus also our lives at the material and immaterial levels. As economist Elton Magoon writes, decisions affecting production and employment are made on the basis of stock prices, and not on the basis of production and employment. A stock price can determine whether thousands of workers are hired, fired, retained, or replaced, can determine whether and where factories are built or put out of service, and so on and so on. But despite having such an immense degree of impact on the world and our lives, we live under a system where the highest valued car company on Wall Street, worth more than pretty much every other major car company combined, does not usually make its profit from producing cars. A world where a beverage company can inflate its stock value more by adding blockchain to its name than it ever could by increasing production or profits. Or, even more detached from any material economic reality, we are living in a world where Fartcoin can be valued at $2 billion, and where corporations will pay over $4 million to buy real estate in a virtual metaverse, all while millions of physical human beings are priced out of finding an actual brick-and-mortar home to live in. Before going any further, perhaps we should briefly consult the dignified science of classical economics to see if we can make sense of this historically unique situation we're in.
Welcome, class, to Economics 101, where we will endeavor to understand the profundity of how individuals and societies make decisions about ways to use scarce resources to fulfill their natural wants and needs. We will begin with some quotes from the great forefathers of this science, such as William Stanley Jevons, who pontificates that repeated reflection and inquiry have led me to the somewhat novel opinion that value depends entirely upon utility. Indubitably. Next, we can turn to the British dignitary David Ricardo, who writes, "If we suppose the occupations of the society extended, that some provide canoes and tackle necessary for fishing, others the seed and rude machinery first used in agriculture, still the same principle would hold true, that the exchangeable value of the commodities produced would be in proportion to the labor bestowed on their production." Indeed. And finally, John Bates Clark elucidates us on how the distribution of the income of society is controlled by a natural law.
Thank God for the eternal science of classical economics. But if the old theories cannot explain how the world became a virtual casino, perhaps we need a new theory that can explain how we became imprisoned by the triumph of economic simulation. This is more precisely where Baudrillard becomes useful to turn to for discovering the forces, or lack thereof, behind the abstract virtualized economy we find ourselves in today. Most people know Baudrillard as a postmodern theorist of media, images, advertising, and culture more generally. He's the person people invoke when they want to say things like we live in a simulation. This isn't entirely unfounded. Baudrillard did write extensively in the domains of media and cultural theory, and the implications of his concepts are often easiest to grasp in cultural forms that explicitly fabricate images, things we can all point to and immediately know as farcical. Baudrillard's economic writings can also be more difficult to understand because we still often think of the economy and money today as the sublime objects of reality. One has to put their money where their mouth is, obviously meaning that one can talk and fabricate as much as they like until the cold hard reality of money comes into the equation, where simulation is tested against the real. And everyone still fantasizes about the markets returning to reality any day now, searching in vain for the fundamentals behind a company's stock price, shorting companies they see as overvalued by markets in comparison to their production and revenue. But according to Baudrillard, all of this is to fundamentally misunderstand economics in the age of simulation. In fact, as we will soon see, the idea that financialized markets still refer to a stable economic ground at all is part of what hyperreal capitalism simulates in order to further subordinate us to it. Moreover, to treat his theory of simulation exclusively as a theory of media is to miss the deeper force of Baudrillard's argument. Even when people do touch on Baudrillard's economic writings, it is usually only in the context of his theory regarding sign value consumerism, where, for example, people buy commodities for the status symbol it represents rather than for any practical function it might serve. But the problem of consumerism is only one small symptom within a much deeper rooted and horrifying economy of codes and simulations that Baudrillard diagnoses. Limiting the discussion of simulation to media and consumerism also risks falling into a trap that Baudrillard repeatedly warned against. The assumption that simulation is confined to those spaces where illusion openly announces itself as illusion. Writing about Disney as the primary example of this type of obviously simulatory phenomenon, Baudrillard claims that Disneyland is presented as imaginary in order to make us believe that the rest is real, whereas all of Los Angeles and the America that surrounds it are no longer real, but belong to the hyperreal order and to the order of simulation. In fact, many of Baudrillard's early works were explicitly about economics. When he develops the concepts for which he is now best known, like simulation, hyperreality, and the code, these are not simply media theories, but always develop out of a deeper economic theory of value. And it is precisely here I find him most prophetic in relation to today's absurd virtualized economy. He writes that, with the flotation of money and signs, alongside the flotation of needs, production, and labor itself, the commutability of every term is accompanied by speculation and a limitless inflation. Not just media images then, but the entire economy begins to float into the air untethered to any ground. And like gods in the heavens, these floating economic elements increasingly come to govern the material reality on the ground. The flows of people and commodities become mere playthings or objects, existing to enact the will of a cybernetic satellite system that hovers above them. As market algorithms, like automatic missile defense systems, instantly process news articles and tweets as mere information signals devoid of material content at speeds no human ever could. Expectations of further expectations of even further expectations become derivatives that get traded along an infinitely extending chain that creates its own financial reality. This illustrates the economic version of what Baudrillard calls the code. He defines the code as cybernetic control, generation through models, differential modulation, feedback, question, answer, etc. This is the new operational configuration. At the limits of an ever more forceful extermination of references and finalities, of a loss of semblances and designators, we find the digital, programmatic sign, which has a purely tactical value, at the intersection of other signals, bits of information or tests, and which has the structure of a micromolecular code of command and control. It is also thus a largely post-human economy, where algorithms and codes increasingly enact a larger and larger majority of trading decisions at accelerating speeds the human could never process, determining reality in advance. Just as I'm writing this, news dropped that Trump would be selling split-second higher speed access to his Truth Social posts, for example. If purchased, these posts will be fed at light speed into what is called an Application Program Interface, or API, which is a digital bridge that allows two computers to talk directly to each other, automatically streaming data into trading software so that AI models can scan posts for information signals that algorithms can then calculate as either a positive or negative score, which is then further used to execute the buying and selling of stocks, derivatives, crypto, and anything else that's tradable on this grand market. So, as we will see, hyper-speculative capitalism becomes unbounded and begins to enter into spatial ecstasy. It drains the material world and its ecosystems of life, and leaves us behind to rot as it carries on its perpetual orbit in space. But in order to understand this hyperreal process, we can begin where Baudrillard himself does, through the everyday realities of language and money. Baudrillard finds an odd analogy at first between traditional linguistic structuralism and classical economics. He claims that Ferdinand de Saussure, one of the founders of modern linguistic structuralism, discovered two dimensions of language that are seemingly analogous to money. Saussure argued that language is not simply a list of words attached to material things. A word does not get its value or meaning simply because it points to an object in the world. It also gets its value from its difference from other words inside the structure of language. We can consider a famous example of the English word sheep compared to the French word mouton. At the simplest referential level, both words can point toward the same animal in the world, so one might think that the value of the word simply comes from pointing to what linguists call its referent, that woolly animal over there. But Saussure claims that in language the referent cannot wholly determine the meaning of a word, because it will always be positioned within a whole network of other words. In English, sheep is differentiated from a lamb as a young sheep, a ram as a male sheep, mutton as sheep meat, goat, cow, deer, etc. as neighboring animal categories. But French divides the field differently. Mouton can mean both the animal and the meat. So English separates sheep from mutton, while French does not separate them in the same way. Thus, even when French mouton and English sheep seem to refer to the same animal, their linguistic value is not identical, because each word belongs to a different differential system where a word gets meaning in relation to other words in which it is not. Technically, a sign is anything that stands for, signals, or functions as something within a communication system, and the referent as the object denoted in the world by a sign is also different from what Saussure calls the signified, since the signified is that which is the mental object or picture one has in their head that is tied to a signifier, the sounded out or written aspect of the sign. But we can largely put these details aside for now. What is important to Baudrillard is how this type of linguistic structuralism becomes analogous to money. Just as every word has these two dimensions of value, so does a coin or a bill. On the one hand, it can be exchanged for a commodity like bread, coffee, or the roof over our heads. That is the ordinary referential side of money. When money appears to point beyond itself towards a real good or service, something materially useful that meets our needs or wants. On the other hand, a coin only has value because it belongs to a whole differential monetary system. A dollar is worth what it is worth because it is different from a cent, a $5 bill, a euro, a Bitcoin, a share of Apple, and everything else in the monetary universe. Its value is not contained inside a material object. A dollar bill is just paper. A number in your bank account is not even paper. Its value comes from its position within a whole structure that is beyond mere reference to any series of material commodities. According to Baudrillard, then, both in classical economics, including Marxist economics, and in classical linguistics, both dimensions here are distinct but related. They interlock and become coherent. But importantly, these systems as a whole find their finality or endpoint on the referential side of the equation. So in language, even though words gain their value differentially through their relations to other words, this differential sign system is still thought to exist for the sake of signification. Whether it be the signified as a mental concept we share when we hear a term, or a referent as an object in the world pointed to by a particular term, the system of language, however differential, is ultimately organized toward a shared communication of such referential or significant objects. To return to our example, the English distinction between sheep and mutton matters because it tells you which word can designate which object in which context. In a field you say sheep, on a plate you say mutton, whereas in French, mouton covers both. So the network of differences is not yet floating freely. It is working to distribute possible acts of reference to objects and concepts. The differential system allows one to be more precise in specifying what a word can be used to mean or pick out. So in ordinary language, we assume a word will point to a concept and that the concept will further point to something real. Likewise, in ordinary classical economics, we assume money points to some real economic substance, whether that be simple commodities, the labor that produced them, or the productive capacity to build further commodities with machines, for instance. Just as the system of words is still supposed to end in meaning or reference, the system of exchange is still supposed to be anchored in use, labor, production, and material need. Money circulates, Prices fluctuate, commodities exchange, but the system still appears to refer back to something real, useful objects, human labor, and production. In this sense, the so-called real economy plays the same role that reference plays in language. It gives the whole structure its apparent ground and destination. But Baudrillard argues that this classical coherence of the two domains in the industrial economy has broken down in contemporary capitalism. He writes that a revolution has put an end to this classical economics of value, a revolution of value itself. This revolution consists in the dislocation of the two aspects of the law of value, which were thought to be coherent and eternally bound as if by a natural law. Referential value is annihilated, giving the structural play of value the upper hand. The structural dimension becomes autonomous by excluding the referential dimension, and is instituted upon the death of reference. Like much of Baudrillard's hyperbolic rhetoric, this can be easy to misunderstand. He is not saying that commodities, workers, or material production literally vanish into thin air. He is rather describing the logical progression away from industrial capitalism, whereby value no longer has to be anchored in what was once considered the reality of the economy. Paradoxically, that former ground is invoked more than ever as it dissolves beneath us. We are constantly reminded of the necessity of useful work, of economic needs, of labor shortages, while the economy itself increasingly becomes displaced into a world of circulating signs and prices, which move independently of that ground and even act upon it as to determine it. This is where Baudrillard's notion of simulation becomes important for understanding the contemporary economy. For Baudrillard, simulation does not mean a fake copy of a real original, nor is simulation simply a copy of a copy as in the Platonic definition. It means that models and signs begin to actually produce the reality they purport to represent as they detach from what was formerly considered that reality. Baudrillard writes that this revolution in value is defined by a total relativity, general commutation, combination, and simulation. Simulation in the sense that, from now on, signs are exchanged against each other rather than against the real. For a great example of this, we can consider a traditional car company on the public market under ideal economic conditions and compare it to a contemporary sign that masquerades as a car company, such as TSLA or Tesla. In the ideal classical model, a car company sells cars, which consists of a series of material production mechanisms that ultimately ends up manufacturing a car commodity that can be sold at a higher price than the car can be made for. On the stock market, the company issues shares in order to raise investment for further production. Investors buy those shares as claims on the future earnings of an actually existing enterprise. The ticker symbol therefore functions as a sign which points to a referent that is a company and its actual or potential profitability for selling cars. Even in the ideal classical economic sense, this includes speculation, but it is speculation that has an alibi in the productive economic reality of a company.
Let's start with a fellow who owns and operates a company that makes and sells oil drums. Each year, customers buy more and more from our friend because he makes a better oil drum than his competitors. One day, customers demand more oil drums than the owner can produce. He'll have to build a larger plant to expand production. He figures it will take about $3 million to do the job. So he decides to form a corporation to sell shares in his business to raise the capital he needs.
Tesla does build and sell cars. It has centralized factories and workers, so it ostensibly still has all this as its model. But TSLA as a sign is clearly almost entirely dislocated from the ostensible referent, the car company that is Tesla. TSLA rather operates as a sign system composed of a futurist mythology, Elon Musk's Reddit persona, and an endless stream of promises that continue to circulate regardless of whether they ever materialize. This is why TSLA could become valued more than pretty much all of the other top car companies combined before it had even become profitable in regards to selling cars. And in more recent years, Tesla stock will often skyrocket rather than fall upon quarterly reports which reveal that their car production and revenue have lowered. Here the sign detaches from its referent and takes on a life of its own that becomes more real than the material economic reality. TSLA can no longer be simply rooted in the referent car company that is Tesla, but neither can it ultimately even be rooted in the referent AI company, nor humanoid robotics company, nor in anything that could give it stable ground. The sign therefore gains a general autonomy from any possible referent and takes on a life of its own. This is precisely what Baudrillard envisioned when he claimed that, when the logic of simulation penetrates the economy, the annihilation of any goal as regards the contents of production allows the latter to function as a code, and the monetary sign, for example, to escape into infinite speculation, beyond all reference to a real of production. TSLA succeeds in the contemporary market as a sign precisely because it lacks a stable material referent in production. Its sign value allows for an unencumbered circulation and inflation no longer held back by those old antiquated metrics of revenue, labor force, and car production that release in quarterly reports which come much too slowly for the contemporary market. But again, this detachment of the economy from materially real production begins far before Tesla, and at a much wider macroeconomic scale. In a section of Symbolic Exchange and Death, simply titled Money, Baudrillard traces what he calls the transformation of money from an ostensibly referential sign into what he names a floating signifier. The term floating here functions in a dual sense. A floating signifier in linguistics is one without a stable referent, but flotation is also an economic concept. A currency can either be floating or pegged. Put simply, a pegged currency's value will be tied to something outside itself, whether that be a commodity such as gold or another currency. A floating currency's value, on the other hand, is allowed to perpetually fluctuate according to the circulation of global markets, rather than being tied to anything substantial. For much of modern history, money was pegged because it had operated under what was called the gold standard. A dollar could be exchanged for a fixed quantity of gold, which meant the monetary sign still pointed beyond itself towards a commodity referent. Baudrillard claims that this was already only a kind of equilibrium, a fragile coherence between the two dimensions of value that we discussed earlier. The gold standard had already ceased to be the representative equivalent of a real production, as classical economics may have imagined monetary value to be, but it still retained traces of this in a certain equilibrium. Gold was already a commodity, and thus already a kind of fictitious element to tie down a currency to. For a series of reasons that are beyond the scope of this video, I'm not advocating for a return to the gold standard, which would be as stupid as it would be impossible. But I do not think Baudrillard is arguing for that either. Rather, the point is simply that, in industrial capitalism, money still retained more material ties to commodities which by definition were tied to their exchange value and the law of exchange or equivalency. And Marx himself had already foreseen within the logic of coinage the decoupling of money from any physical ties, when he writes that there exists the latent possibility of replacing metallic coins by tokens of some other material, by symbols serving the same purposes as coins. It is obvious now that this latent possibility has long been in effect, since the pretense of money having a stable referent has long vanished. According to Baudrillard, a dollar's value is now constituted entirely by its differential relation to other monetary signs, the same way that a word's meaning is now constituted by its differential relation to other words. There is no longer any material production that it ultimately refers to. It simply floats. And in the process, the primary logic and function of money intensifies to a point where it goes beyond exchange to a certain extent. From Aristotle all the way up to many modern economic theorists, money was understood as a medium of exchange meant to facilitate trade and acquire necessary goods, but we can no longer say this is the case. Baudrillard writes that today money escapes exchange value. Freed from the market itself, it becomes an autonomous simulacrum, becoming a message itself and exchanging amongst itself, which then circulates at a greater rate than everything else. Obviously, we can still buy and exchange things with money, but what Baudrillard means here is that money no longer primarily functions as a stable measure of value grounded in production, commodities, labor time, or even meeting human needs. Instead, money gets principally evaluated beyond any such references in its self-referential speculative exchange, becoming autonomous. It is no surprise then that algorithms themselves increasingly become the main actors within speculative exchanges, creating an entirely self-referential cybernetic system of exchange. But the point here is that, just like TSLA, money itself is already largely dislocated from what classical economics would call the real productive economy, and it can then transform into a self-referential system of virtual and speculative exchange whereby material reality needs to adjust itself to the sign value of money tokens or financial asset tickers. Even though Baudrillard is fairly critical of Marx at this stage in his thought, I think returning to Marx can help explain the underlying logic of this movement. Baudrillard mischaracterizes Marx when he lumps him in with classical economists who define the end goal of the economy by use value, that is, meeting people's wants and needs with commodities. In Capital, Marx does cover this type of logic with the formula CMC, which does define an economic logic of more earlier societies, or even how money functions at an individual everyday level. This formula basically means I sell a commodity to earn money in order to buy another commodity to suit my needs. For a simple example, a blacksmith sells a sword in order to make the money to buy bread. But even by Marx's time, he already thought this formula failed to capture the true logic of capitalism. For industrial capitalism at large, where wealth exists to generate more wealth, things are more complicated. Marx gives us a new formula, MCM apostrophe, where the apostrophe simply means more or surplus. You start with money, you buy a commodity, like raw materials, machines, or labor, you produce something, and you sell it for more money than you started with. Money becomes commodity that then becomes more money. The production of commodities with use values to be sold and consumed is the crucial middle step, but not the logical endpoint of the process anymore. Yet it can still be what justifies and generates the movement from money to surplus money. But despite this industrial conception where value is still rooted in production, Marx allows room for what he characterizes as the most fetishized version of capital. Here the commodity is bypassed altogether, so that the formula simply becomes compressed to M apostrophe. Money directly produces more money, without need of commodities to mediate this circulation. Economist Achim Szepanski writes that, for Baudrillard, the current priority of circulation, capital is first and foremost the circulation of the M apostrophe, over production, entails that the pressure for liquidity that dominates the financial markets is tied to the imperative that capital must circulate in the M apostrophe and must not have a fixed point, that speculative investments must be constantly renewed, and that value must radiate without ceasing. High-frequency trading algorithms, derivatives markets, shadow banking, and crypto. These are all the extreme expressions of an economic system that has increasingly learned to skip the inconvenient middle step of having to actually produce something material. So this is the function of global capital now, and its ultimate logic is rooted in a dialectic of excess and lack. What separates Marx from the classical economists who Baudrillard sometimes groups him in with is that Marx rejects the ordinary economic picture where scarcity comes first, where humans have natural needs and wants, where goods are limited, and therefore action begins from lack in order to meet these natural needs further. For Marx, capital actually begins from a perpetually absent surplus. So there is a lack, but it is not simply rooted in human needs or wants, but rather the lack is rooted in the system's demand for more, for perpetual increase. This is why the economy values, or at least gets us to value, objects that are more and more virtual and abstract. It creates new human needs according to its own self-referential science system, in order to feed its imperative for surplus capital. And as our needs become increasingly virtual and less material, capital strikes again and again against the material commodity that might slow down its acceleration even a little bit. And the surplus driving this system will never be present in any positive sense. It will always be fleeting. It functions more as an axiom directing the process so that each iteration of money points beyond itself towards a more that hasn't yet arrived. The dream of capital is therefore to pass through the commodity as quickly as possible, or bypass it altogether. But the more it approaches this threshold, the more the economy becomes cybernetic, a system of signals, feedback loops, predictions, and automatic adjustments that communicate with one another through information wholly devoid of content. The trading of financial signs and derivatives of financial signs upon signs increasingly becomes the operational code through which the economy is made to move. So when we now turn to global finance, we are now seeing it enter its most extreme form beyond consumerism. Money's perpetual spiraling circulation no longer represents production, but circulates above it, evaluates it, anticipates it, and increasingly determines it. This is the world of M apostrophe at the planetary scale, money trying to produce more money through the pure circulation of signs. We must now consider how this floating sign exchange and simulatory finance system plays out at the planetary scale, in order to understand the phenomenology of a world where everything circulates faster and faster virtually without needing to pass through things being made. In an essay titled Trans-Economics, Baudrillard presents us with an image of such a world. There is something much more shattering than inflation, he writes, and that is the mass of floating money whirling about the earth in an orbital rondo. Money is now the only genuine artificial satellite, a pure artifact. It enjoys a truly astral mobility. Money has now found its proper place, a place far more wondrous than the stock exchange, the orbit in which it rises and sets like some artificial sun. The majority of global financial transactions today take place at speeds no human body could register, between algorithms, across time zones, in markets that never close, governed by models whose outputs feed into other models whose outputs feed into yet more models. This is capital in pure circulation that has no end beyond itself. Most of it never arrives at the point where it might build infrastructure. It might never even arrive at becoming paper money. It simply transfers itself across various different digital signs within the code. It often never even gets to the point where it materializes into a luxurious lifestyle for those who have the most of it, instead of a traditional bourgeois class who lavish in the money they amassed, where money at least had arrived somewhere even if it was completely disproportionately distributed. We now have a class of tech oligarchs who prefer to keep their money in circulation while bragging about their minimalist lifestyles. In order to maintain their status at the top of this hierarchy, they too must sacrifice to the autotelic code of hyperreal capitalism. Again, we see this with figures like Elon Musk, likely to become the first trillionaire in history, who spends every waking hour on Twitter plugging himself into the same sign economy as the rest of us, being eaten alive by the machinery he ostensibly owns, manipulated by the algorithms that his own companies seemingly developed. Capital seems to have freed itself from every friction, every anchor, every tether to the material processes it supposedly serves, and it now circulates permanently above them, leaving everything else to decay below. Despite its autonomy, often the catastrophes that develop out of its orbital acceleration blow back on the ground, as it were, with the 2008 economic crisis as one of the clearest examples of this. Such crises do not necessarily restore the priority of the material economy, though. If anything, they often reveal the opposite, that the financial simulacrum has the upper hand, has an autonomy over everything and everyone else. The financial simulacrum's own simulative and detached logic led to the 2008 collapse, causing a surge in homelessness and poverty for just a few examples of its widespread material consequences. Yet, after 2008, this hyper-capitalist system did not really face any radical reforms or changes. Instead, it was the entire material economy that had to be reorganized in order to ensure the recovery of financialized capitalism. After 2008, shadow banks and institutional investors used trillions in central bank and state support, not primarily for productive industrial expansion, but for whole new slates of speculative financial activity, derivatives, stocks, corporate bonds, as well as real estate and high-yield corporate debt. And since then, the market's autonomous and cybernetic speculative activity has only accelerated further. Baudrillard writes that the new trans-economics of speculation plays at obeying the old economic logic, the law of value, the laws of the market, production, all the classical laws of capital. Orbital financialized capital remains virtual, floating, and protected, while local economic damage happens everywhere else. It is as if when such an alien satellite system sheds its skin, its material debris will mysteriously fall and crash into Earth, where we feel its effects everywhere while never fully understanding the nature of it. It simulates being grounded in productive reality so as to blind us to the new real that has emerged, the hyperreality of unbounded speculation. The illusion that there is a productive economy underneath that drives the financial one above, that imaginary economic reality that we perpetually expect to reassert itself in times of crisis, is partially what allows the financial simulation system to persist. In his book The Agony of Power, Baudrillard calls the new configuration turbo-capitalism, and he means the phrase very literally. The system, he writes, is no longer driven by historical forces, but is absorbed by its final conditions, hastened to its definitive end, like a turbo engine sucking in the space in front of it, creating a vacuum and the force of attraction of a vacuum. It is not a progressive, continuous evolution. Instead, it is a vertiginous, irresistible attraction to its own end. A turbo engine uses its own exhaust to accelerate itself. It feeds on its own byproduct. Turbocapitalism does the same. It uses its own crises, its own speculative excess, and its own waste or debris to fuel the next cycle of acceleration. This is starkly opposed to what we find in Marx, where the crises inevitably produced by capitalism provided the ideal logical conditions for the overthrowing of capitalism itself. For example, Marx writes that a new revolution is possible only in consequence of a new crisis. It is, however, just as certain as this crisis. Baudrillard finds that crises no longer constitute such ruptures in the system. They instead become a driving energy of turbo-capitalism. Certain financial sectors, like high-frequency algorithmized trading firms, even find their peak profits during crises. As Szepanski notes, crises are welcome opportunities for money robots to increase their profits. For example, the debt crisis in Greece, which led to high price fluctuations, especially in derivatives on the financial markets, and thus to increased buying and selling decisions, with the increased demand causing spreads to rise. The increased trading volume plus higher spreads therefore led to higher profits, which ordinary savers, pension investors, and insurance policyholders, among others, also had to pay. Baudrillard then poses a question he deems nearly unanswerable. Can we still speak of a market or even of a classical economy? Historically, he notes, the market obeys the law of value and equivalency, and the crises of capital can always be resolved by regulating value. But regulation assumes that there is a stable measure of value to be regulated back into, a referent that can be appealed to as the ground of exchange. And that is precisely what the trans economy has liquidated. This is no longer true for the financial flows and international speculation that far surpass the laws of the market. Can we still speak of capital when faced with the exponential strategy that pushes capital beyond its own limits, into a whirlwind of exchanges where capital loses its very essence and self-destructs in an unbridled circulation that brings the very concept of exchange to an end? The very concept of exchange, meaning the principle that two things will always have a comparable, measurable value rooted in some coherent ground, that principle dissolves when value itself begins to refer not to production, labor, or material substance, but to other values, other prices, other expectations, and other signs. Paradoxically, having lost its rational principle, Baudrillard concludes that exchange becomes total, just as reality, having lost its reality principle, becomes total reality. Total exchange, where everything is always already in circulation. Everything is a sign pointing to another sign in a chain extending to infinity, and this has gotten only more absurd since Baudrillard's time. A big part of this is due to a sub-element of sign value that is most valued now in the hyperreal economy, speculative value. Speculative value is something well known in economics and can first be defined simply as the difference between a company's present book value, its actual assets and current earnings, and its estimated future value as priced by financial markets. The formula for valuation is generally total market value equals book value plus speculative value. When internet stocks in 2000 traded at a price-to-earnings ratio of 45, compared to a historical average of 10 to 15, speculative value was essentially everything. The company was being priced not for what it had produced, but for the mythology of what it could become. Szepanski writes that such dot-com companies had no trading history and owned no assets. They did not generate profits or dividends, and therefore could not be valued using traditional accounting measures. New investment logics had to be developed whereby companies with the highest valuations would sell business models based on revenue projections far into the future without much regard for likelihood of materialization. They thus sold a sign system oriented towards an imagined future. And when the bubble collapsed in 2000, both the US and UK stock markets lost more than half their value, and most of those companies became worthless. But what followed was not a return to sober, production-grounded investment. Rather, what occurred was a migration of speculative energy to the next mythology. Speculative capital functions like fashion, constantly reinventing new sign regimes and mythologies and outmoding prior models, so that money never stops circulating beyond any reference to the so-called real. Szepanski writes, Baudrillard is right in that almost all economic objects that are traded today are overwritten with signs that are created in financial companies. The more removed the financial representation is from the material object or subject, the more possibilities and potentials arise for the creation of financial simulacra that expand the scope for speculative pricing. And the more readily a specific future mythology is accepted, the greater the real capacity for speculative capital accumulation. Corresponding with our initial analysis that found TSLA to be detached from its ostensible referent in Tesla the car company, once this separation is complete, the sign evidently falls into boundless speculation. 5 years after TSLA had reached an evaluation higher than any other car company, despite having no profit from selling cars, the company had still failed to meet its early revenue projections or deliver on many of Elon Musk's promises, including the full self-driving capability he initially claimed Tesla vehicles would have by 2016. For this reason, people still believing TSLA refers to the car company Tesla have projected for years that the company's value would collapse. But as its promises do not come to fruition and get deferred, more signs and myths of the future are cycled in to maintain its speculative value. For example, much of this value no longer rests on the promise of full self-driving alone, but on the mythos surrounding artificially intelligent humanoid robots and fully autonomous taxi services, even though it has not yet demonstrated serious production capacity in either area. What orthodox economics cannot account for, but Baudrillard's framework makes obvious, is the fact that materiality actively works against TSLA's financial value. An example of this can be located just in January of this year when, upon the release of bad earnings reports and the discontinuation of production of several flagship models of cars, Musk also broadcast that his so-called car company was to invest $2 billion in Elon's Grok AI, and again, the stock price rose substantially. The material referent is displaced by a floating speculative sign so that the more determinately real a company becomes, the less room there is for the sign to float. TSLA's sign survives not in spite of the perpetual deferral of its promises, but because of it. The worse the quarterly report gets, the more the stock can paradoxically rise as long as a new mythology is produced, as long as the chain of infinite expectations continues to flow so that market algorithms can continue trading such derivatives. And this brings us to another important element of the financial simulacrum's architecture, derivatives markets. And I think we can understand them through Baudrillard's conception of fractals. A fractal, defined loosely, is a pattern in which a small part resembles the larger whole at every scale of magnification. Szepanski shows how in a fractal, each small part, when enlarged, has the same statistical character as the original. A branch has the same shape as the tree it grows from, and the twig has the same shape as the branch. A snowflake, however closely you zoom in, keeps mimicking its own patterns. It is characteristic of the fractal object that is completely contained in its smallest details. And a derivative, at its simplest, is a financial contract whose value derives from something else, such as a stock or commodity price. Instead of buying the thing, you buy a contract ostensibly about the thing, such as whether it will trade higher or lower within a certain period of time. But as Szepanski explains, this is only the beginning of the logic here. For Baudrillard, each derivative would not only be a copy that could be exchanged for any other derivative at any time, but would also contain a copy of itself. The derivatives are simultaneously worth different amounts, and yet they represent each other perfectly, so that they can reproduce themselves in any fractal environment. A derivative doesn't just represent an underlying asset. It contains the same generative logic that can produce more derivatives, and more derivatives, and more derivatives. Each copy is a machine for producing further copies. The clearest way to explain this today is through cryptocurrency and its derivatives markets, because here we don't even start with something that is supposed to be attached to a referent in material production like a stock price. Rather, we commence from something hyperreal that further proliferates fractals of itself. Take for example Ethereum, a widely used blockchain network. A blockchain is essentially a shared digital ledger, a record of transactions that is maintained by a decentralized network of computers rather than by any single bank or government. Because of the lack of a centralized system to detect false transactions, blockchains like Ethereum need some way to ensure that bad actors with computers in the system will not approve false transactions. So therefore people must stake Ethereum's native cryptocurrency, ETH, in order to have a kind of deposit that will be destroyed if a computer falsifies transactions. Just like a rental deposit is supposed to ensure you won't wreck your apartment. ETH generates a return, like it would if you had invested in a bond. And, also similarly to bond investments, that staked crypto is illiquid, not always readily available to you whenever you may need it. To solve for this problem where a return is generated but unable to be freely spent, a new category of financial product was invented: liquid staking tokens. Protocols like Lido take your ETH, stake it on your behalf, and in exchange give you a new token called STETH, which represents your staked ETH position. STETH can then be traded, transferred, or used in other financial applications while your underlying ETH keeps generating staking rewards. So now you have ETH to staked ETH to STETH, a derivative sign representing the staking position. And we can already see the derivative fractal-like logic here. STETH is not technically ETH. It is a financial sign that derives its value from ETH while becoming tradable as its own object. But it doesn't stop there, since STETH can then be used as collateral to borrow more ETH, which can itself be staked to produce more STETH, which can be staked again through protocols like EigenLayer, in a process called restaking, where staked assets are redeployed to secure additional networks on top of Ethereum. At each level, a new tokenized position is potentially created. So you can get chains like ETH to staked ETH to STETH to restaked STETH to further tokenized positions, and so on and so on. And this is fractalization as it applies to derivatives. Starting from a virtual and speculative financial sign that can be used self-referentially to secure a network of exchange for those very signs. Each layer can be used to further generate derivative copies that continue the chain, increasing liquidity and speculative value along the way. The derivative is a copy of a copy of a copy until it no longer makes sense to speak of an original and a copy anymore. It's simply another speculative sign used to further a hypothetically infinite circulation of such signs. And this isn't unique at all to crypto. Already in traditional financial markets, the same logic was there, through options pricing models that shape the prices they purport to describe, and through traded pools of debt that proliferate speculative collateralized debt obligations which can be further traded in tranches. In such a fractalization process, where derivatives spawn further and further derivatives to form a chain, also accelerates risk the further it goes. Often, as we saw in the Ethereum example, every link in the chain promises to manage risk or distribute risk or make risk liquid. But each new layer also creates new dependencies, new feedback loops, and new sites of collapse. This is what Szepanski calls a catastrophic logic of linkages, which he finds exemplified in the 2008 economic crisis, when real estate debt derivatives multiplied themselves beyond regulative control. Once one of the links break, the whole chain can collapse. This also has begun to surface on a much smaller scale when we saw a break in the chain of ETH staking derivatives. Finance researcher Cynthia Chang similarly terms this chain a leverage tower that multiplies risks in an economic process termed rehypothecation. In our age of hyperspeculative capital, then, the traditional economic definition of speculative value wholly fails to take into account how far things have come, especially when we consider that many experts estimate that the value in the derivatives market is over $1 quadrillion. This is why Baudrillard writes that speculation is not surplus value. It is a sort of ecstasy of value, utterly detached from production and its real conditions. A pure, empty form, the purged form of value operating on nothing but its own revolving motion. In Baudrillard's usage, ecstasy means something stepping outside of itself, a system that has exceeded its own purpose and now runs on its own excess as fuel. A terrorist is the ecstatic form of violence, just as the pornographic is the ecstatic form of sex. Things that have amplified themselves beyond their own finality until they tip into something that is more than themselves and thus also less than themselves. Speculation is the ecstatic form of capitalist surplus value. Not more careful profit-seeking, but profit-seeking that has departed from the conditions that made profit meaningful in the first place. In Das Kapital, Marx wrote about how capital is a vampire that only survives by feeding on the living labor of humans. But now capital feeds on everything and drains it of blood, even cannibalizing our future in the process. Szepanski writes that hypercapitalism comes to generate a monstrous auto-cannibalism, in the course of which it wants to absorb everything forever, until it eventually inflates itself to death and destroys the earth. Speculative capital cannibalizes even the number. To spit it out undigested is over more, and it is in its peculiar emptiness the zero, which multiplies the fiction of always more, 10, 100, 1000, etc. No longer feeding simply on productive labor, capital swallows the mathematical forms used to represent economic reality. It consumes the measuring instrument. The zero becomes a multiplication engine, because in the system of speculative inflation, even nothing can be leveraged into more of the same. Like the derivatives trading of crypto revealed, the system has learned to generate excess from the formal structures of calculation themselves, independently of any underlying material production. The derivatives market is not simply a fixed list of possibilities of the kind that is usually attributed to speculative value in traditional economics. Within the derivatives market, one can recombine positions, risks, contracts, and cash flows into further sets of possibilities. Then those possibilities can be recombined again and again to the nth degree. Hyperspeculation increasingly becomes more speculative than speculation itself the further the derivative chain extends. The M' of capital has become cybernetic and in excess of itself at all levels. Its models are always trading off of expectations of a future that can never truly arrive, since a future that is materialized would fail to include the continued unbounded inflation of speculative value that the system demands. Capital thus continually approaches a limit that is devoid of its own empty motion. More money from money, more debt from debt, more speculative value from speculative value, each iteration pointing towards a surplus, an asymptote that it can never fully cross without being annihilated. This is what Marx had already foreseen when he wrote that the maximum realization of capital, as also the maximum continuity of the production process, is circulation time posited as equals zero. In other words, then, the conditions under which capital produces, its restriction by circulation time, the necessity of going through the different phases of its metamorphosis, are suspended. It is the necessary tendency of capital to strive to equate circulation time to zero, to suspend itself. This is why capital is always invested so heavily in transportation, communication, and more recently digital infrastructure, not necessarily for the goods moved or the information carried, but for the reduction of friction, the ideal elimination of the spatial and temporal gap between M to M', capital and more capital. But capital cannot actually reduce its cycle time to zero. A zero cycle time would be a capital that had overtaken itself, that had arrived before it departed, which is not accumulation but dissolution. And yet this is precisely the horizon that speculative financial capital now approaches asymptotically. High-frequency trading algorithms operate at nanosecond speeds where, as Szepanski notes, even the speed of light in high-frequency trading can be too slow. When traders in London are preferred over Frankfurt because the signal sent at the speed of light takes longer to reach the computer algorithm in Frankfurt to execute a trade. Ecstatic speculative capital is approaching the speed of its own impossibility, moving so quickly it begins to lag behind itself. What it comes to generate is not material wealth, but the hysterical simulation of infinite wealth that remains in perpetual motion. This is a hyperspeculative temporality, where the future never appears as open and unknown, since financial capital demands to price the future in advance of itself, where everything is calculated into a field of risks, expectations, and returns that is all priced and traded in the present. The future in the financial present thus also becomes swollen with derivatives, debt, inflation, liquidity, and self-referential financial claims to it. In such a way, all genuine newness is siphoned out of the future, because every future event across the globe, from the point of view of the present, has already been calculated in advance, so that the system can presuppose its infinite expanse into the future. According to this logic of hyperspeculative capital, then, the revolution itself will be priced in advance and traded. But as it accelerates further and further past itself into the future, its true death drive is revealed, and the void it spirals into continues to deepen. This is why Baudrillard writes, just as networks connect all points on the globe and all markets in real time through universal electronic interactions, events enter a network or follow each other in a symbolic hyperspace, no matter what their nature. Attacks, disasters, accidents, and epidemics all go in the same direction, and they can join in a chain reaction because their objective causes are indifferent or marginal, and they seem to obey an eternal logic, their own escalation. This system should worry much less about revolution than about what is developing in the void. For example, climate change is precisely the kind of event that should, in principle, announce a genuinely new future as a rupture in the conditions of material life, demanding transformation so deep that the existing relations of capital would have to be reconsidered from the ground up. Instead, what has actually happened is that climate catastrophe has been absorbed into hypercapitalism's risk future, translated into carbon credits, catastrophe bonds, insurance models, and climate derivatives. Even if speculative capital fails to price in the true gravity of this future, its predictive models already precede and generate our response to the coming catastrophe. They shape state planning, insurance premiums, and the social simulative atmosphere that determines how we think and feel about such issues. This is illustrated in the truly devious case of ExxonMobil, whereby internal Exxon scientists had accurately projected and skillfully modeled global warming due to fossil fuel burning since the late 1970s and early 1980s. They accurately predicted when human-caused global warming would first be detectable, and reasonably estimated how much CO2 would lead to catastrophic warming for the planet. The company's internal models to estimate climate change from the 1970s onward were comparable to, or better than, the government and academic models. It was their future finances on the line that would be affected by the coming crisis, and thus they were the first true responders to it. Climate change became real as a financialized risk future before it became realized as a social and political future that would shape the globe. One of their key concerns while studying the phenomenon so ahead of time was how government regulation would affect their company's future value. Thus, the company financed media campaigns that cast doubt on its own science while politically lobbying against climate regulations. The future was real insofar as it had to be priced in by speculative capital, certainly more real in this sense than it was politically, where it could have served as a basis for real future social change. The same pattern appears in the insurance industry, which has long incorporated the future consequences of climate change into its models through higher premiums, and is at times even withdrawn completely from high-risk areas. Yet, despite being treated as a fact by capital for decades, climate change remains politically contested. This ensures that capitalism and its existing social relations will survive unscathed, while the global population, wildlife, nature, and the world itself are made to absorb the costs no matter how deadly they may be. A worthy sacrifice for the hyper-speculative system. No matter how much damage accumulates below, financialized capital must continue its orbit even as the world decays beneath it. On one side of things, the cybernetic system disputes its own science that predicts and prices in the coming catastrophe. On the other side, it converts those who might not be so convinced through state capitalist green initiatives and eco-friendly products. Companies like Tesla present themselves in their mythology as the sign that the future has arrived as redeemed. Not an eschatology that would bring real change, but one that maintains the hegemony of financial capital while promising to solve the crises it unleashes. Despite electric vehicles in general not being a viable ecological solution at scale, TSLA has managed to increase its sign value due to this mythology too, profiting off of the crisis they promise to solve. Szepanski specifies that financial markets have decontextualized and mathematized the climate problem to such an extent that little relevance for global warming remains. The creation of private property rights in the form of emission certificates has turned the right to pollute into a commodity that can be traded across borders. For example, many illegitimate preservation projects are set up across the Amazon rainforest in order to farm carbon credits from private international registries. Those credits can then be detached from the specific forests they were generated from and sold for millions to an industrial emitter across the globe, who purchases such a commodity so it can get away with polluting more. The ecological referent, the actual forest, the actual atmosphere, or the actual planetary system itself, becomes dislocated from the financial sign, the carbon credit, in precisely the structure we saw Baudrillard identify earlier. We see this in the business model of TSLA as well. While masquerading as a car company, When Tesla has actually been profitable in its quarterly reports, more often than not it wasn't from selling cars, but selling state-administered green credits. TSLA earns these financial tokens for producing zero-emission vehicles. These credits can then be sold to other companies as a kind of derivative that allows the companies to further sell gas-guzzling trucks and SUVs without facing fines for breaking with environmental regulations. The system converts ecological necessity into a permissions market, where the limit that is the atmosphere's capacity to absorb carbon becomes a price. And Tesla, the apparent sign of the coming future change, generates a substantial portion of its income from the system's failure to change. It becomes reliant on the system not changing, and it prices in that stagnation in order to maintain its speculative value. The speculative promise of change therefore presupposes no real change.
The electric car is here.
It is almost as if the hypercapitalist system moves so fast it reaches a point of stasis, bloated from its self-cannibalization. Even as it moves frantically, its movements increasingly become dependent on a series of crises it promises to manage, but whose promises also must be perpetually deferred, so that it can carry itself forward further and further into the future, until the future is entirely effaced. Szepanski writes that world capitalism has entered a paradoxical, accelerating, and at the same time exhausting panic mode or a deadly excess, in which the ecstasy of the over as over-accumulation and over-speculation meet the destructive activities of capital, especially with regard to the capitalization of nature. So finally we see a system that feeds on its own byproducts, cannibalizing its own measuring instruments, which converts every limit into a new speculative frontier, whilst converting every catastrophe into a new asset class with its own set of derivatives, forever approaching the horizon of its own impossibility. But as it goes into orbital overdrive, almost eliminating time and space entirely as its friction points, the system fails to take everyone and everything with it. Hyperglobalization tears open new spaces and times as it attempts to swallow all space and time, incision points which escape its totalizing process. Nature itself can make manifest such incision points. First, because it is imagined by the system as a passive object simply waiting to be incorporated and swallowed by the financial code, environmental disasters such as hurricanes, earthquakes, and viral pandemics become an affront to a system that requires everything subordinate itself to its version of the future, the speculative risk future. Second, due to how tied up nature has become with a financialized system and its chains of derivatives and markets that imagine themselves wholly sovereign over it, when natural disasters do occur, their effects become intensified at all levels, leading to chain-like events of economic collapse as we saw during COVID and Hurricane Katrina. Natural catastrophes are therefore no longer merely external accidents. They become capital's own transformed nature returning as a limit. The more the system calculates, monitors, invests, and predicts it, the more nature generates runaway effects. Baudrillard illustrates this when he writes that the violence of natural disorders increases with the intensification of technological violence. Deregulation grows at the same rate as excesses in control and calculation. It is as if nature were exacting revenge in the name of all the peoples sacrificed and disowned. A symbolic backlash of insupportable hegemony, of the technological arraigning to which nature responds in the terrorist form of earthquakes and eruptions. In the insurrection of natural elements, there is a hint of reprisal. The more the system tries to preempt the future as risk, the more the future returns as an event that is capable of rupturing that logic. But nature merely gives us the initial hint of the insurrection bubbling under such a system that internally produces blowback by means of its perpetual expanse. This is why Baudrillard so presciently announced that the more intense this hegemonic process of forced integration and integral reality is, the more singularities will rise against it. There will be more rogue states like Iran, Palestine, that deliberately exclude themselves from the international community without waiting to be excluded, that exclude themselves from the universal and play their own game, at their own risk and peril. There will be more rogue events and more refusal of society. To find the only adversary who will face this all-powerful hegemony, we must look for those beings that are exiled from dialogue and representation, exiled from knowledge and history. We must look for the less dead than us. With the recent events in Iran and the Strait of Hormuz, we've thus all become witness to what such a rogue event looks like, and it applies to the entire hypercapitalist hegemony. What occurred could be described as a return of the repressed. A return of the repressed physical boundaries of the spaces that limit the form of accumulation and value. Hormuz was a singularity that ruptures the system's fantasy of absolute frictionless circulation and its mythological transcendence above the material world. And if the global system now relies more heavily on circulation than production, then the capacity to block such global circulation becomes the most powerful force of resistance. Iran obviously doesn't stand outside of capital. It sells oil and must operate diplomatically to a certain extent. But it nonetheless interrupted the otherwise autonomous cybernetic system of smooth global economic circulation. Under so much pressure for integration by the entire hegemonic world casino, Iran refused to play its game, and just might win. It effectively forced the financial system to recognize a spatial-temporal limit that it might not be able to entirely dissolve. And because of the chain-like logic of this financial sign and derivative exchange, this singular event produced a chain reaction of crises. The strait is first made commercially risky to navigate. Shipping risk becomes insurance risk, leading to an oil supply shock. The oil future market, while still artificially held up, can turn further potential scarcity into a present price. Higher oil prices then become inflation expectations, affecting costs of many goods, investment expectations, and state reserve policy. And then we saw Trump announce, upon reaching a potential deal, that we would have run out of oil reserves in a month, and that,
And there'll be a time when you wouldn't be able to get it, and you want to see Bedlam?
and then somehow, this domino effect even reached the seemingly most abstracted markets, crashing crypto. Iran also managed to disrupt the hypercapitalist simulation of the Gulf states, which once provided the illusion of a safe space for representatives of global finance capital to meet in their mall cities and act out the will of the cybernetic system that they serve. Iran, if only for a moment, represented a symbolic refusal of the entire order, a willingness for sacrifice, which is exactly what cannot be absorbed by such a system. This is what Baudrillard calls an irreducible antagonism to the global principle of generalized exchange. The systematic violence of the system is reversed in such singular moments of refusal that occur when turbo-capitalist hegemony thinks it can absorb and swallow everything whole. It becomes a confrontation that is no longer precisely political but metaphysical and symbolic in the strong sense. Whether or not the Strait of Hormuz will resume normal tanker traffic quickly enough to prevent the bedlam Trump himself had described remains the defining economic question of a crisis the system itself ultimately had the greatest role in creating. Even if the system is in seeming recovery for now, what the Hormuz crisis leaves behind at this point is not a wholly transformed order but a set of exposed truths. That the orbital financial system, for all its claims to pure self-referential circulation, depends on specific, irreplaceable points in material space. That the speculative risk future, for all its sophistication, cannot model in advance the persistence of a less codified, determined actor, willing to accept the costs the financial system cannot price in. Because turbo-capitalism's acceleration can never truly abolish the friction of space and time. It can only postpone its encounter with it, and make that encounter only more catastrophic for having deferred it so long. Szepanski writes that, the catastrophe is a hole between before and after, which cannot be absorbed by the old rationality, while a new normality is awaited. We are now in that liminal waiting period, unsure if the old rationality of hypercapitalism will renormalize the world as it stands. The system is extraordinarily good at converting its holes into more financial signs. But the hole was there, and in that moment, the most powerful person in the world, at a summit of the 7 richest nations, admitted that the world would have faced conditions not seen since 1929, A level of material apocalypse the entire apparatus of orbital speculative capital could not have prevented, if Iran, having possession over one simple strait, had not agreed to let ships through. So the world is a casino, and the future is speculation. The satellite still orbits, and beneath it all, 21 miles of water between Iran and Oman quietly reminded us what this casino truly runs on.